Welcome to the Fear and Greed Daily Interview. I'm Sean Aylmer. 2023 is looking like a better year for deals, with M&A activity set to rebound in the next 12 months. Deal-making slowed this year with economic uncertainty and rising interest rates acting as a handbrake. But leading independent law firm Corrs Chambers Westgarth predicts that could be about to change. Sandy Mack is the head of corporate at Corrs Chambers Westgarth. Sandy, welcome to Fear and Greed.
Thank you very much, Sean. Thank you for having me.
So 2021 was a bumper year. In fact, we seem to be talking about deals left, right and centre. We started 2022 and there are a few deals on the table. I think, I might be wrong here, but I actually think the money was paid to the Afterpay shareholders in January this year, which means that was the biggest deal of them all. But there just seems to be a dearth of deals this year relative to last year. Is that fair call?
Look, I think to put everything into perspective, 2021 is just one of those years that I think we're unlikely to see for a while. And the statistics that we have in our survey for 2022 bring us back down to sort of the pre-COVID levels, if you like, which were pretty healthy. It's just that relative to 21, it seems like we're having a quieter year. What is interesting about 22, though, is that about half of our deals were done in the first quarter of the year. So there's definitely been a tailing off in the latter half of the year, and that is very much attributed to higher interest rates. So therefore, the costs of acquisition financing going up, which in turn then drives valuation gaps, buyers and sellers, very much like the housing market, where you got a seller for a house that still wants prices back in 21, but you got a buyer looking for a bargain. Bridging that valuation gap is the challenge. And so we're very busy.
Okay. It just seemed that there were a few deals also in the last 6 months or so that fell over seemingly more than normal. Now, that might be wrong again, but perhaps it just reflects the higher interest rates. I suppose Ramsay Healthcare was an example. Link Group, I think, was another example. Were there more bids that didn't end up being executed than normal, do you think?
So that is very much a tale of two cities, actually. A very interesting point. I think that there were a lot of deals that people tried to announce that didn't get off the ground. Ramsay is a good example. And there were multiple other transactions in the market, like the Telus bid for Appen and a bunch of other tech deals where there were processes and nothing got signed. Link is an interesting example of something that did get signed and then ultimately fell over. But our statistics actually show that there were fewer of those sorts of deals this year than there were last year. And that was because last year and in 2020 in particular, when we were still going through that COVID period of uncertainty, many people introduced these material adverse change conditions into their deals. And when something happened, like there was another shutdown or discretionary spending tailed off, many buyers decided that they didn't want to go ahead and do the deal anymore, and then relied on these material adverse change clauses to terminate the transaction. In 2022, we saw far fewer material adverse change clauses terminations. And I think that's just reflective of a market where the target boards are saying, I need deal certainty for my shareholders, and I'm not prepared to agree to very broad material adverse change clauses that allow buyers to walk when something happens.
Okay. It kind of begs the question then, is M&A activity more likely to pick up if we have stable markets, or do we end up seeing a lot more M&A activity when prices are downtrodden? People don't want to take risk, so we find equity assets relatively cheap versus historical standards, so people jump in at that point? Or is that economic stability more important?
It's a confluence of factors, Sean. I think you need certainty from certain perspectives. So, for example, on interest rates, buyers are going to want to understand where the inflationary pressures on the businesses that they are buying are and how much it's going to cost from an acquisition financing perspective. So that the settling down and certainty in that aspect is really important. Market volatility makes doing deals difficult if things are jumping up and down. But a downward turn in the stock market is not of itself a bad thing, particularly for public M&A, because it just means that valuations go down. And as long as they stay down and they don't keep fluctuating, then buyers have a much stronger sense of confidence about the value at which they're getting some of these assets. So yes, a downward trend in the stock market actually does perversely sometimes see an increase in public M&A transactions.
Stay with me, Sandy. We'll be back in a minute. My guest this morning is Sandy Mack, Head of Corporate at Corrs Chambers Westgarth. Okay, so let's talk about what you expect to happen in 2023. You think that M&A activity will pick up in the middle of next year? Why?
So I'm going to go out on a limb on this one. And that's my personal prediction. And the reason for that is because I do think that, to my earlier point, the inflationary pressures, the interest rate movements, I think they're going to stabilize in the second half of 2023. And once we have that, barring a significant geopolitical development that none of us have predicted, I think you get a much better sense of what things are going to cost, how much they're going to cost, and whether or not you're going to be able to make a good return out of the values that you're getting on the market. So for those reasons, I think that we're going to see a big uptick. Now, it's not going to be in all sectors. So certain sectors, and we are seeing this play out right now in terms of competitive bids for oil and gas assets, for a lot of the energy transition related assets. There's been a lot of interest for anything to do with digitization and tech. Those are the hot sectors, and I suspect that they will continue to be the ones where we'll see the most activity next year.
Okay. Are any of the out of favour sectors likely to see a little bit more interest, do you think?
Well, we had a prediction in there, and I will wait and see whether I'm wrong. But we did think that some of the out of favor sectors in the COVID times, particularly in things like travel, retail, discretionary spending on cosmetic procedures, adventures, experiences, all of the enjoyable things in life that we didn't get to experience during COVID that took a big hit. We think they'll come back. I think the cap on that will be whether or not inflation really starts to bite and consumer spending stops. But at the moment in Australia, there's this very strange dichotomy between inflation and retail spending. It hasn't really slowed down in the way that the Reserve Bank has been expecting or hoping. And that's because our employment rates are really high as well. But it may get to a point where those sorts of sectors just start to become unattractive. The other thing that is really difficult to do is that there has been a bit of a jump in those sectors, these out of favor sectors that have now come back into favor again. And what you need to do when you're a buyer is you need to reverse out all of this bump in spending because it's not normal. Like it might normalize at a later point in time, and therefore trying to work out what your normal level of earnings and profit will be on a go-forward long-term basis will be the trick in those areas.
Okay. So what about, you mentioned transition commodities. That's something that's likely to be popular. What about other big thematics? So we've been through COVID, and the thematics that were there before COVID are probably still there now, ESG being a very obvious one. Do you think some of those will play out in the next year or so? Some of those sort of, now that we're post-COVID?
Yes. Look, I think ESG is more than just a function of post-COVID. I think it's a function of clearly, all of the climate change considerations and the direction in which the world is heading in terms of expectations of corporates and governments. The geopolitical situation that's playing out in Russia and the Ukraine and Europe has really impacted on how the energy transition story is going to play out. So that oil and gas really do have a much bigger role, in my view, to play as part of that story. And that is why you are seeing, for example, the three-way tussle for Warrego Energy at the moment. All of that is a function of private enterprise recognizing that oil and gas has a significant role to play in that story. The other interesting thematic, I think, will be, and again associated with geopolitical uncertainty, is which foreign bidders will continue to dominate activity in Australia. Historically, Australia has always been a net importer of foreign capital. And so foreign bidders, in the 12 years that we've been doing this survey, for most of that time, foreign bidders were the majority of the buyers in the market. And in the last 2 years, Australian bidders have overtaken foreign bidders in the M&A space.
So are we talking super funds here? Are we talking about the big pension funds being more active and potentially increasingly being more active?
We're looking at some very significant investment from superannuation funds and large Canadian pension funds, for example. And I expect that they will continue to be very active. I expect that we'll continue to see that trend of Australian superannuation funds directly co-investing into public M&A transactions, which is a relatively new trend where they take stakes alongside private equity bidders, for example.
Is it a good or a bad thing? Because as an investor, obviously my super fund is investing my money too, but as an investor, the bigger role some of those guys play, the more I have to look to diversify my investments, which means perhaps looking offshore more or looking at alternatives more or whatever.
I suppose it depends on which lens you're looking at it. I think the Australian retail investor community really does struggle to find good assets.
What we are seeing that's really interesting is the rise of more effectively private equity style funds, but for retail. And that's probably where people are going to start putting more and more of their money if they're not finding the right investments in the listed company space directly.
Sandy, thank you for talking to Fear and Greed.
Thank you very much for having me.
That was Sandy Mack, Head of Corporate at Corrs Chambers Westgarth. This is the Fear and Greed Daily Interview. Remember, this information is general in nature and doesn't consider your personal circumstances. Join us every morning for the full episode of Fear and Greed, Australia's most popular business podcast. I'm Sean Aylmer. Enjoy your day.